Welcome to the Investing Insights podcast from Morningstar.com. This podcast is brought to you by the Morningstar channel for Roku. Enjoy insightful, independent video content in your living room. Download the Morningstar channel to your Roku today. This week on the podcast, Brian Colello breaks down Apple's earnings, Russ Kinnell shares his favorite funds for retirement, Christine Benz looks at how rising rates affect retirees, Aaron Lash says P&G's attractive dividend should continue to grow, John Hale talks about investing for impact, and our equity analysts give their takes on the Chinese economy and Amazon's healthcare partnership. So let's get started. Here's Brian Colello with his take on Apple's earnings.
Apple reported strong results for the December quarter. They gave weak guidance for the March quarter. This was a bit expected because there were some reports about iPhone 10 production cuts. But probably the biggest news from Apple's earnings is that they intend to be net cash neutral after the U.S. tax reform and their ability to bring all of their cash overseas. Apple's holding on to $163 billion of net cash at this point, and they intend to spend almost all of it on dividends and buybacks over the next few years. They haven't given a time frame. They'll update it in April after the March quarter. But this is a move that surprised us. We thought that Apple would be a bit more conservative with its ability to access cash, as they have had a historically conservative capital structure. So this one really caught us by surprise. That's why the stock moved to up 3% after hours. It was flat before that. Looking at the actual results, Q1 revenue for the December quarter was quite strong. iPhone revenue was strong. iPhone units were slightly light, but not too bad. The bigger factor was the mix towards the iPhone 10. These are higher priced phones. ASPs of $796 were exceptional, up 15% year over year. So flattish sort of sales, but higher prices on those phones really led to a strong quarter for Apple. The other nice part was the other products business, wearables. Apple Watch and AirPods in particular surprised us. Apple's second quarter forecast for the March quarter was weak, but it wasn't overly surprising, and it certainly could have been worse. We've seen reports that Apple's cutting production of the iPhone 10. A couple of chip makers that supply into Apple gave weak guidance for the March quarter, citing softness in smartphone demand. This isn't a total surprise to us. You have the iPhone 10, the highest priced phone. These usually sell very early on in the process, and then inventory wanes, particularly when you get into the spring and summer months. So Apple does adjust inventory around this time. So not a total surprise that Apple's cutting production. Certainly it's a negative, but and the guidance is weaker than expected, but it certainly could have been a lot worse. The gross margin guidance is good. It looks like there will still be decent sales of the iPhone 8 and 8 Plus. And with the good news about the cash distributions coming out in the future, investors are still relatively happy with Apple's report.
Overwhelmed by the market? Morningstar Premium will help you cut through the noise and find the most promising investments. Get started today with Morningstar Premium.
Now, Russ Kinnell shares his favorite funds for retirement.
Hi, I'm Christine Benz for Morningstar.com. What makes a fund a top pick for a retirement portfolio? Joining me to share some of his favorite retirement picks is Russ Kinnell. He's Director of Manager Research for Morningstar. Russ, thank you so much for being here.
I'm glad to be here.
Russ, let's talk about retirement holdings. Say someone is in retirement. Do you think their holdings should necessarily look different than the holdings that someone who's still in accumulation mode should hold, apart from the asset allocation decisions?
Maybe a little bit, maybe a little more caution, but obviously even when you're in retirement, you still probably have a long-term time horizon. So I don't think it should be a drastic difference, but when you look at it, you may want to adjust risk down a little bit, but also think about if you've, as you mentioned, changed the asset allocation, so you've got a lot more in fixed income, then you may also want to be aware of some of those specific fixed income risks, which if it was 20% of your portfolio, it didn't matter. But now if it's, let's say, 50, 60, 70%, now you want to think about things like interest rate risk and inflation risk as well.
So diversify within that bond portfolio. You might build out positions that you didn't really have room for before.
Exactly.
Okay. And should costs play a greater role in the equation when you're retired, or should they be a huge consideration all the way through?
Yeah, I would say costs are always crucial for sure, but certainly in retirement, I think you'll the expenses are subtracted from income, and so the lower your fees, the more income is going to be flowing through to you.
Okay. In your newsletter, Morningstar Fund Investor, you have a lot of funds that you talk about that you like, but I asked you to bring some of your favorite ideas for retiree portfolios, and you brought a grab bag of different categories. One that you brought is a core intermediate term bond fund. Let's talk about that one.
Yeah, I think intermediate makes sense just because there's a little less interest rate risk. And intermediate is a really diverse category. There's some very aggressive funds in there. I brought one on the conservative end. Fidelity Intermediate Term Bond is a fund that it has interest rate risk below the peer group average. It has credit risk below the peer group average. So it's very mild-mannered. But if you've also got high yield or some other riskier funds out in your portfolio, this is kind of a nice core anchor for you. Because it's so low risk, it's actually hasn't had great performance lately. But again, I think that's okay if you understand what you're getting. But it's got low costs. It's run well, and I think a really nice, dependable, yet boring fund.
So for investors who are looking at their portfolios and seeing that their equity holdings have gotten enlarged and perhaps want to tip back and add a little to the bond piece, it sounds like this is a good core pick.
Exactly.
Okay. That Fidelity fund is a taxable bond fund, so you'd want to be sure to hold it inside some sort of tax-sheltered retirement account. How about a fund for investors, retired investors' taxable accounts? You have a pick there.
Yeah, I like T. Rowe Price Summit Muni Income or Muni Intermediate Fund because it doesn't have really big interest rate risk. It does have a little bit of credit risk, and so they take some risks at the margins, but Charlie Hill's done a really nice job guiding this fund through thick and thin, and I think it's a kind of steady performer that, again, is a really nice fund. Obviously, not all retirees need munis. It depends on what your tax situation is. You might want to talk to your accountant and see
that makes sense.
What kind of tax bracket you can anticipate being in, but I think it's a really nice, steady fund. Again, munis behave a little differently from taxable funds, so you're getting a little more diversified. You're getting some tax breaks. Obviously, the tax issues are in flux these days, but I would talk to your accountant. I think it's a nice, steady fund.
Okay. Those are core funds, the Fidelity Fund and the T. Rowe Price Fund. Now let's talk about a fund that's a little more of a niche holding. You'd maybe want to hold a smaller position in it. That's Fidelity Floating Rate High Income.
That's right. So what you get with bank loan funds like this one is essentially no interest rate risk because the coupons adjust with changes in interest rates. So you're covered if there's a spike in interest rates, but you do get some credit risk because these are bank loans to companies, and so there is some risk there. There's some liquidity challenges, and so this fund in particular holds a meaningful amount in cash so that it's easier to manage inflows and outflows. That makes it on the more conservative end of bank loan funds. But again, I think that's a reasonable way to go, is take on a low risk credit risk, especially this long into an economic expansion. I think it's good to be a little more cautious. But we haven't had much interest rate risk in a long time, but presumably there's still some scenario in which interest rates spike, and this is a good fund to hold in that time.
Okay, so the first three were all fixed income picks. Now let's take a look at an equity pick. And first, let's talk about why investors in retirement want to be thinking about making room for international equity exposure as part of their portfolios.
There's a common misperception that international equity is higher risk, and in fact, people across the world all think the other markets are higher risk, which doesn't really add up. And I think it's a useful diversifier. So don't avoid foreign equities just because it sounds higher risk. I think it's still a worthwhile place to invest. By a lot of measures, foreign equities are cheaper than the U.S. right now. So I would still pay attention to foreign equities and still have some money in there, even in retirement.
Okay. So the fund you're highlighting today is Causeway International Value. Its managers won our International Stock Manager of the Year award honors for 2017.
That's right, and it's rated gold. So needless to say, we really like this fund. It's run by Sarah Ketterer and Harry Hartford. They've been running it for about 15 years since leaving Hotchkiss and Wiley. Just a very good, solid value fund. I chose value just because value has been a little more out of favor than growth these days. So it's contrarian in a couple of ways, but very solid. Consistent value fund, a nice offset if you've got a lot of growth exposure these days.
Where does it stand in relation to the emerging versus developed markets question?
Oh, that's a great question because it has no emerging markets exposure, so it's unusual in that way too. So if you want emerging markets exposure, you'll have to get an additional fund, but they draw the line very clearly here. It's just a developed market fund.
Okay, good to know. Russ, thank you so much for being here to share these picks today.
You're welcome.
Thanks for watching. I'm Christine Benz for Morningstar.com.
Can your portfolio weather the market? Use our premium portfolio tools to identify risks and streamline your holdings. Get started today with Morningstar Premium.
Next up, Christine Benz looks at how rising interest rates affect retirees.
For Morningstar, I'm Jeremy Glazer. Interest rates have been on the rise in 2018 after being placid for quite some time. I'm here with Christine Benz. She's our Director of Personal Finance to see what this means for retirees. Christine, thanks for joining me.
Jeremy, great to be here.
Let's start by thinking about kind of the most obvious impact of rising rates, which is on bond prices. Can you tell us why rising rates mean that bond prices fall?
Well, the simple reason is that when higher yields come online, that depresses the value of already existing bonds because they have lower yields attached to them. So you tend to see this inverse relationship: when yields go up, bond prices go down, and the opposite also happens. So when yields go down, bond prices go up, and that's the great tailwind that bond fund investors have had over the past several decades, where we've seen declining yields and rising bond prices. Right now, we're starting to see a little bit of the opposite effect.
Not all bonds are created equal. What categories have been hit particularly hard?
Right. When we look at bond fund category performance so far here in 2018, as you would expect, the long-term bonds have been hit particularly hard. Long government bonds tend to be especially interest rate sensitive. Long-term core bond funds have also been hit hard. Even core type intermediate term funds have taken a little bit of hit to principal even as higher yields have come online.
We're talking about bond funds here.
Yes.
Investors say, okay, well, if it's going to hurt my bond fund, then why don't I just hold individual bonds, hold them to maturity? Then I don't need to care about what happens with interest rates. Why would that be a good or bad strategy?
It's a great question, and one that I get an awful lot. And the fact is that if you are buying, say, treasury bonds or very high-quality corporate bonds, that can be a sensible strategy. Once you move beyond those very high-quality bonds, though, I think that there are some risks that start to crop up. One is that it can be difficult to research some of the less frequently traded credits, and it might also be difficult to build a well-diversified portfolio of individual credits, especially if you're a smaller investor who's not buying thousands and thousands of dollars in individual bonds. And then another thing to keep in mind is that bid-ask spreads can come into play, and in talking this through with some of our manager research analysts, it seems that the municipal space, so people who are buying and selling individual municipal bonds, would be especially vulnerable to steep bid-ask spreads that can actually take a chunk out of the yields that they receive. So that's another thing to bear in mind.
Another area investors might look at to try to get away from interest rate risk is to take on more credit risk, so buy riskier bonds or maybe non-dollar denominated bonds. Those have been holding up better so far this year.
They have. They've been performing really well. So when we look at the top performing bond category so far in 2018, despite this little bit of interest rate disruption, we've seen emerging markets, local currency denominated bonds perform very well. Emerging markets bond funds in general have performed really well. High yield bonds, bank loan investments or floating rate investments, all of these categories have done really well. That's in large part because people are pretty sanguine about the strength of the economy, the strength of the global economy for that matter. So these bonds have held their ground pretty well, and of course they do have higher yields attached to them to begin with, so that tends to provide a little bit of a cushion even when we see interest rates jump up.
If you're worried about losses in bonds, why not just hold cash?
Well, a couple of key reasons. I would say actually that the opportunity cost of holding cash has never been lower, because when we look at the differential between even say a high-quality short-term bond fund and true FDIC insured cash instruments today, it's really, really low. So you can find an online savings account with a 1.5% yield today. A high-quality short-term bond fund might be yielding like 1.7, 1.8% if you're lucky. That's a pretty slim margin considering that the cash instrument is FDIC insured. So I think investors, if they do have very near-term expenses that they're going to have to meet, and this is certainly the case for retirees looking to build cash flow for retirement, you probably do want to hold that money in cash rather than venturing out and taking even a little bit of risk with some sort of a bond fund, even a short-term bond fund.
How do you figure out that balance of how much cash you need?
I always say that investors should use their cash flow needs to dictate how much to hold in cash. So as you know, I write and talk a lot about this bucket strategy for retirement portfolio construction. And the starting point that I tell investors to use is to think about their portfolio withdrawal needs and put like 6 months to 2 years worth of those withdrawals in cash. The rest can kind of get staged by withdrawal timeline. So maybe the next 3 to 8 or 3 to 10 years worth of withdrawal needs in bonds, and then the remainder can go into higher returning, higher risk assets, namely stocks.
You said you could find potentially 1.5% in an online savings account. How do you figure out where that cash should go? I know a lot of sweep accounts and brokerage, and brokerage accounts are still going to be pretty low, at least in terms of interest.
That's right. So for investors who have gotten complacent about their cash, just sort of figuring that this is dead money, why should I bother? It's time to get out there and take a look at what your cash investments are yielding today. Online savings accounts, in my view, offer the best balance of that daily liquidity, check writing in some cases, as well as a pretty decent yield today, as you said, of about 1.5%. Money market mutual funds have historically been able to offer higher yields, in part because you don't get those FDIC protections. So even though money market funds are now governed by tighter strictures than was the case, say, a decade ago, you still need to bear in mind that those are not FDIC insured. So there's a trade-off, even though in some cases you're able to pick up higher yields.
Finally, let's talk about debt. Higher rates means higher rates on debt as well. If you are holding debt in retirement, how do you think about that payoff if you do have cash?
Yeah, think about the variability, and this is especially true for people who might hold home equity lines of credit into retirement who are still servicing those debts. I think the combination of the fact that we're seeing yields trend up, as well as the new tax laws which affect the deductibility of home equity interest, should really make many retirees take another look at whether they want to be carrying that debt around. And I also think it's valuable to look at the complexion of your investment portfolio, look at the return prospects of that investment portfolio. If your portfolio's return prospects are muted, to me that accentuates the value of prepaying debt rather than letting it ride.
Christine, thanks for your thoughts on rising rates today.
Thank you, Jeremy.
For Morningstar, I'm Jeremy Glazer. Thanks for watching.
Watch all the Morningstar content you love from your living room. Download the Morningstar Roku channel and get up-to-date independent insights on today's markets. Be comfortable. Be informed.
Now Aaron Lash says P&G's attractive dividend should continue to grow.
Wide Moat Procter & Gamble pays one of the more attractive dividends across the household and personal care landscape, with a dividend that yields north of 3% annually, far in excess of the low single digits its peers boast. From our vantage point, P&G's commitment to returning excess cash to shareholders is evident in the fact that it's paid a growing or stable dividend for nearly 130 years, and we anticipate that it will continue to prioritize returning excess cash to shareholders as we forecast its dividend will grow at a mid to high single-digit clip annually over the course of the next 10 years. Looking back, P&G has focused more recently on further bolstering its competitive position by shedding more than half of its brands as a means by which to focus on its highest return opportunities, while also extracting excess costs, the combination of which we think stands to bolster profitability and further free up funds for the firm to allocate to bolster shareholder returns. As such, we forecast that P&G will direct around 70% of its annual earnings toward the payment of dividends for the benefit of shareholders going forward. Despite its leading competitive edge, we believe that Procter & Gamble is not immune to the intense competitive headwinds that are plaguing its peers. More specifically, Procter & Gamble has chalked up stagnant top-line growth over the recent past, as other global branded players, lower-priced private label fare, as well as small niche operators work to chip away at Procter & Gamble's leading share position. However, we view the firm's efforts to reinvest behind its brands, both in the form of marketing as well as product innovation, as a means by which to offset these headwinds. From a valuation perspective, we think Procter & Gamble's stock is attractively valued, trading at around a 10% discount to our valuation. And when combined with its attractive dividend yield, we think long-term investors would be wise to stock up on this wide moat name.
Go from one investment analyst to 150. Sign up today for Morningstar Premium and let our independent and unbiased research staff help you find the best investments. Get started today with Morningstar Premium.
Next, John Hale talks about investing for impact.
For Morningstar, I'm Jeremy Glazer. The New York City pension funds have announced that they're going to be divesting from fossil fuels. I'm here with John Hale. He's our Director of Sustainable Investing Research. We're going to see what this could mean for investors who are thinking about making an impact with their portfolios. John, thanks for joining me.
My pleasure.
So let's take a quick look at this announcement about this divestment from fossil fuels. Is this the continuation of a trend? We've seen a lot of pension funds take these kind of steps.
Definitely, we're seeing a lot of pension plans doing this, and if not going fully into divestment, there are some other areas that they are exploring as well, like sort of best-in-class investing, or just even engaging with the companies that they do own in their portfolios.
Let's take a look at some of these options. It could be illuminating for people who are thinking about their own portfolios. The first is a full divestment. What is the case that's being made to walk away from these companies?
Yeah, well, I think divestment, first of all, probably interesting to talk about divestment in kind of in terms of the criticism that is made about divestments, which is basically, that if you take something out of your portfolio for sort of non-investment related reasons, you risk, it's said underperformance. What it really is tracking error. You risk tracking error. You could underperform, you could outperform over time. And it's very interesting, I thought, that GMO recently came out with a quick study that they did where they took the S&P 500 and they took out a sector at a time and sort of looked at what the S&P 500, X energy looked like, X, financials, X healthcare. Went back 20 years, 50 years, 90 years. What they found really doesn't make a lot of difference in return. So, the primary case, I think, against divestment that, well, you're risking a lot of tracking error, not that big of a deal. But I think in addition to that, we've seen over the last few years an investment case developed for divestment, which is basically that your large fossil fuel companies, especially the major extractors of coal, oil, and natural gas, are companies that are going to find it much more costly to operate over the not too distant future. And so a divestment in fossil fuels really is saying we don't think these are great investments going forward. We have some evidence, certainly in the last few years, that that's been the case, despite the natural gas boom of the last few years. The MSCI All Country World Index ex fossil fuels has outperformed the base index over the last 7 years by about a percentage point annually.
Another option is just looking at best-in-class investments instead of saying, I'm not going to own fossil fuels, you own the least polluting or the ones that are the best stewards. Yeah. Why would people gravitate towards this option? Well,
best-in-class is really saying, we're not going to take out everybody. We're going to just sort of focus on those that in this sort of transition to a low-carbon economy are handling that better than their peers and are sort of improving their sustainability performance in areas like managing their carbon footprint, energy efficiency, maybe even investing in renewables. So that's definitely a way to go as well.
And then finally, there's engagement, and we hear a lot of this, particularly from the passive index providers who have to own everyone. What's the case for owning them, but then engaging with management to try to make a change?
Right. Well, engagement is having a seat at the table as a shareholder, and we're seeing quite a lot of action on that front recently in the engagement world. Just last year, for example, 63% of the shareholders of Exxon, including their largest fund company shareholders like BlackRock and Vanguard and State Street, all voted to encourage the company to release regular reports to investors about the risks they face from climate change. BlackRock just announced they were indeed going to do that just last month. In addition, there's a group of investors called the Climate 100 Task Force that have bound together this year and said, we're going to coordinate our engagements with the 100 companies that have the heaviest carbon footprint globally to talk to them about how to reduce that footprint and what their plans are for the future. So certainly engagement can be effective. I think tilting portfolios towards best in class can be effective, but so can fossil fuel divestment. They're not as mutually exclusive as they might seem. You can do sort of combinations of all three. And I think it's, investors have a choice here of paths they want to take, and it's just really not that productive to say, oh, one's good, one's bad. I think they all can serve a purpose.
John, thanks for walking us through that today.
My pleasure.
For Morningstar, I'm Jeremy Glazer. Thanks for watching.
No matter what part of the market you're targeting, Morningstar Premium Screeners are your shortcut to finding the best investments. Get started today with Morningstar Premium.
And lastly this week, our equity analysts give their takes on the Chinese economy and the Amazon healthcare partnership.
Despite the appearance of steady growth in official GDP and other headline measures, China's economy has likely been cooling for the past several months. Morningstar's Power Proxy, which sums GDP-weighted sectoral electricity demand to estimate changes in total economic output, has signaled slowing growth since September. Deceleration is also evident in other alternative measures. For example, our raw materials-based proxy of fixed asset investment suggests spending growth slipped from about 3% in the third quarter to nearly zero in the fourth quarter. Now that's important because fixed asset investment accounts for 44% of Chinese GDP. We're also seeing some signs of softness in consumer spending, although not nearly to the same extent that we are on the fixed asset investment side of the economy. So why is China's economy slowing? It's largely because the credit stimulus that led to the most recent economic upswing is being withdrawn. Now, historically, credit has led economic activity in China by about 6 to 12 months. So the slowdown that we're seeing now is a consequence of waning credit growth from earlier in 2017. With credit growth continuing to slow in the fourth quarter, we expect the economy will decelerate further in the first half of 2018, especially on the more credit-sensitive fixed asset investment side of the economy. Now, despite slower credit growth in 2017, economy-wide leverage continued to rise. We estimate total debt to GDP in China reached about 260% at year-end. That was largely due to an increase in household mortgage debt. So China's once lightly leveraged households now carry one of the heaviest debt burdens among major and middle-income countries at nearly 50% of GDP. That's up from only 11% a decade ago. So while we continue to expect consumer spending to perform fairly well in the decade to come, especially relative to fixed asset investment, the growing household debt burden is becoming a greater concern.
With the announcement today of Amazon, JP Morgan, and Berkshire Hathaway forming a potential healthcare behemoth, many of the healthcare services firms have sold off over the course of this morning. However, we believe this sell-off is overdone. In the past, many major corporations have tried partnerships in order to bring healthcare costs down. However, because their core competency is not healthcare, and because it's very dynamic and a very complex space, they haven't been as successful as what some industry analysts have believed. In addition, we believe the buying power of a combined trio of JP Morgan, Berkshire Hathaway, and Amazon will pale in comparison to what the healthcare services firms have built over the past several decades. We believe, again, the sell-off here for many of these stocks is overdone. The moats for these companies, the wide moats for the PBMs, and the narrow moats for the MCOs are still intact, and will continue to allow these companies to produce significant competitive advantages and economic profitability over the next several decades.
That does it for this week's Investing Insights podcast from Morningstar.com. We hope you have enjoyed our program, and we welcome your feedback. Please send your comments and questions to podcast@Morningstar.com. From everyone here at Morningstar, thanks for listening.